Welcome back to the channel, everyone. We are breaking down one of the most consequential signals in fintech this year. A signal so critical it re-rates the entire future of Sofi Technologies. I'm talking about the major research note that just dropped from William Blair, and it validates everything we've been saying. Stop everything you're doing right now and listen to this core headline. William Blair has officially admitted and validated that Sofi is a tech platform, not just a bank. That one phrase changes everything. That single conceptual shift re-rates the entire future earnings potential of a company. Let's start right there with the conviction behind that signal. We pulled the core headline from the research, and the language is clear. It's not ambiguous at all. They aren't saying hold or even buy on strength. They are explicitly telling investors to scoop up on weakness. That aggressive, that high conviction language is so critical. It tells you everything you need to know about how the institution views the current price. It's a direct, urgent signal to the big players, pension funds, mutual funds, hedge funds, that the time to act is now. The psychology behind a note like that is telling. The analyst sees this recent dip, this short-term fear, as an error in pricing, a market mistake that needs to be corrected by significant capital inflows. They are using this high conviction call to explicitly override that short-term fear the Friday flush created. Now, let's forget the short-term noise for a second. This validation that Sofi is a technology platform, that's arguably the most important fundamental shift here. Absolutely, understanding this recognition is the aha moment that you really need to grasp, because it justifies a massive valuation shift. Okay, explain that. What does that mean for the stock price? If you're seen purely as a traditional bank, your valuation multiple, the ratio of share price to earnings, is typically very conservative. We're talking, bracketed between 8 to 10 times earnings. That's right. That low multiple reflects the inherent risk of traditional lending, the slow growth, the high capital requirements. But the analysis is arguing that this classification is now just outdated. It doesn't apply to Sofi anymore. So, if they're validated as a tech platform, what does that do to the valuation? It changes the entire game. If you are validated as a tech platform, particularly one with high margin, recurring fee-driven revenue and platform infrastructure, that justifies repricing the stock to a much higher tier. How much higher are we talking? We're talking somewhere in the range of 30 to 50 times earnings. Think about that gap, 8 to 10 on the low end versus 30 to 50 on the high end. That is a multi-bagger opportunity based purely on a classification change driven by their fee-driven revenue and their Galileo platform. This is the heart of the bullish thesis. And when you look at the performance history, the confidence from William Blair is definitely grounded in reality. The research gives us this phenomenal performance check. It really reinforces that idea that winners keep winning because the stock has just established massive relative strength. The numbers don't lie. If we look at the numbers, Sofi year-to-date is up a staggering plus 89%. 89%. That's not just beating the market. It's vastly, significantly outperforming the S&P 500, which is up around, 16.5%. You just can't ignore that kind of relative strength. That is the central message the analysts are sending to the institutions. When a stock has run up nearly 90% in a year, a slight dip is merely a retest of its strength, not a breakdown of the whole thesis. And the shorts are betting against that strength. This performance history is the very thing they're betting against. The analysts are basically calling them out, saying, your thesis is fatally flawed by the company's established trajectory. This brings us directly to the concept of the bear trap. The current dip, the Friday flush, is being labeled a bear trap. Why? Because the psychological barrier for bears has been broken. They couldn't hold the stock below that $29 level on the initial breakout. Exactly. Imagine the internal pressure on a short seller right now. They need the stock to fall back below $29 to confirm their bearish thesis. But now they're seeing a major analyst explicitly yelling scoop up right at the price they need to hold. that forces short sellers to either cover immediately or risk massive pain if the stock bounces, creating the trap and creating a very real bear trap where buying pressure gets compounded by shorts getting squeezed. That fear drives the strategy. Let's shift now to the technical setup, which the research calls a healthy retest. This gives us a clear, actionable strategy for how to engage with this bullish news. Precisely. If we look at the charts, the most critical element after a breakout is something technicians call the support flip. Yeah, after a stock makes a big move up, its old ceiling, that psychological point where sellers used to dominate, it must now hold as a floor. So it's like a ceiling of resistance has now become a floor of support. That's the perfect way to visualize it. The old $29 level, which had been a serious multi-month zone of resistance, right where sellers always stepped in. Exactly. That has now clearly flipped to become a critical support zone. The price action is coming back down to test the strength of that new floor. And when it bounces, when the price bounces off that former ceiling, it's a textbook pattern. It confirms the underlying breakout is robust and well-sustainable. This is the key to minimizing risk and maximizing reward. But we need to know exactly when to enter. This brings us to the necessity of front-running institutional capital. The concept of front-running is necessary here. If institutions know the critical support is $29, they will bid slightly higher to make sure they get their shares. This necessitates a front-run adjustment for anyone looking to enter this trade successfully. Now, let's talk confirmation. If the market opens red, which is a very real possibility, panic is the enemy. What's the visual trigger we need to see that confirms the buyers are showing up at the $29.10 level? You need to look for high volume rejection around that 29.10 level. Specifically, the instruction is to watch for a long wick on the candlestick. The wick. That's the telltale sign that the price was pushed down aggressively. But massive buying volume immediately stepped in and pushed it right back up, leaving just a shadow or a wick at the bottom of the candle. So, you're seeing the battle in real time. You're seeing buying pressure overcome selling pressure in real time. And the critical instruction here is, do not panic if you see red at the open. Wait for that rejection wick to form. That level of clarity is just invaluable for navigating volatility. Okay, let's get the exact coordinates that define the trade structure. This is your plan. The strategy execution demands precision, especially with that front-running activity. The analyst defines the critical buy zone or the scoop zone for institutions as the bracket between $29 and $29.25. Because of the aggressive bullish news, the adjusted entry zone for retail traders is slightly tighter and higher. You should target between $29.10 and $29.25. This lets you get a quick fill just above the absolute floor, getting in before the major funds finish their accumulation. Now let's make sure we clearly outline the upside targets and, most importantly, the safety net, the line in the sand that invalidates the whole thing. We have 3 key levels here, and they must be defined before you enter. Asterisk near-term resistance, $30.50. This is the immediate psychological pause point. The first spot where early dip buyers might take some initial profits. Asterisk breakout target, the big prize $32.50. That's the next major liquidity zone where the price is expected to gravitate once this current accumulation phase is over. It represents the next structural milestone. Asterisk the stop loss, the line in the sand. This defines the invalidation point for the entire trade structure, and it is set at $28.40. If the price closes below $28.40, the entire resistance support flip at $29 has failed. The technical structure is invalidated, and the trade thesis has to be reevaluated. That is how you define your risk. So let's bring it all home. We have confirmation from a major institutional analyst using aggressive language to override market fear. We have a fundamental justification for a much higher valuation, moving from a bank multiple toward a tech multiple. And critically, we have a clear, aligned technical roadmap centered around that $29 resistance turn support level, complete with specific entry and exit coordinates. If we connect this to the bigger picture, you know what's the real implication for the whole fintech sector when major institutional analysts not only change their valuation framework, but they also use such aggressive language, the scoop-up call, to signal entry zones? It suggests the market is officially beginning a formal structural reevaluation of companies that can bridge banking services with genuine, high-margin platform technology. This isn't just about one stock. It's about validating a whole new financial business model. The signal is clear. The plan is set. The fundamentals are strong, and the technicals are aligned for a powerful move higher. Sofi is validated. Its trajectory is clear. And the institutional capital is confirming the dip is a gift. Trade smart. We'll see you next time.